Like that's usually where the
Mm,
money starts, it disappears
risky,
and whoops.
very risky. Yeah, yeah, yeah. I mean, if it's a green pasture, if it's something too good to be true, it really is.
Yeah.
Please watch those words. If somebody says, I can double your money, I can triple your money, and this and that, never, never, never invest. Look at who you are putting money into, understand the vehicle. There was a very good book, actually, about stock market, and it was the Magellan Fund, number one fund, billions of dollars, many years back. I forget the publisher's name, but he was the CFO or CEO. And when he retired, he wrote the book. He said, only invest in the things that you understand. Even the
Yeah.
companies, what they do, you need to understand.
That's exactly right. So we're giving you a lot of advice right now. This is not financial advice. This is things we've
Mm,
learned, and we're pulling information from other sources as well. So as
yeah.
we're going through and diving into what we invest in and why we invest, we're not going to go too deep into the details of what it is.
No,
We want you
no.
to really listen to put the money aside for a reason. If you put the money aside, now if you're putting money aside, let's say it's $10,000, and you let a year go by, it's sat in not a bank account, it's just sat under your bed. One, a
Mhm.
fire could burn the money and it's gone. Now you don't have that money.
Yeah,
It's just cash. So cash is very dangerous. Saving
yeah.
in a bank account is better, but it only earns 1%, less than 1%. So if your inflation rate's
Mhm.
8% or 7%, you're losing 6 or 8%, 7% per year. You
Yeah,
start shifting into assets that the hold period is longer. Maybe it's not as liquid, but you put the hold period into a 5 or 7 or a 10-year asset class that gives you a 15 or a 25% IRR or a 20% IRR.
yeah.
You start
Mhm.
looking at okay, I gave you a word. Internal rate of return. That's
Yeah.
the
IRR. Yep.
8% preferred rate that you're getting annually plus the equity exposure you get inside the project,
Yes, yes.
which can lead to a doubling. I know Vinny just said don't double your money, but doubling over 5 years is realistic. Doubling
Five
over seven
years.
years,
Yeah.
it's realistic. That's
Yep. Mhm.
25% means 4 years of doubling. So 20% would be 5 years of doubling. And those are numbers you can look for as you're evaluating this. So the next step is you put money not just to save for a rainy day. That's liquid. Yeah, maybe you need 5,000, 10,000 for a rainy day. But once you get past that threshold and you get your runway of like be able to pay your bills for a couple of months, you start not needing, but you start wanting to get to money growing for you, kind of like these mountains. They didn't grow overnight, but they're pushed up by other forces, right? Forces external to you. So you put your money into something that's giving you a 15 or a 20% IRR, you end up with 5 years from now a doubling. While
Yeah.
you were working and putting that more money aside, that money went out and doubled for you, and now it creates more opportunity for your life. It's like having a second employee. Right? If you're earning $100,000 a year, over 5 years, you're able to save 20% of your income. That's 5 years you worked to save $100,000. But now you
Hmm.
invest that in a project. That project's working just as hard as you, so
Yeah.
5 years from now, it's earned 100,000. Well, you did that same thing again. Now the doubling factor is now being doubled by that asset plus you, plus now in 5 years, you can make that double type of investment. Now you got four assets
Yeah.
that are paid
Hmm.
for by like three of them were paid for by other assets. You
Totally,
start you
totally.
start thinking it's like scale 5 years, 10
Mhm.
years from now, your net worth should be 4 times heavier than it is today with the right investments.
I am so glad we are talking about this.